Warsh has made a lot of comments about what he thinks communication needs to be out of the Fed and how that needs to change compared to how they used to do it. But at this point, he cannot wave a magic wand and say, no, we're cutting interest rates by this much.
Thanks so much for joining us on this episode of Trends Talk. We at ITR, your apolitical and unbiased source of economic intelligence. And today we have a special guest, my colleague Lauren. You probably recognize her from our Fed Watch series, and I wanted to talk about the Fed and inflation today. So I figured no better person to have on than Lauren. We appreciate you joining us.
Thanks, Taylor. So glad to be here.
I figured we'd start with, I guess, a fundamental question, which is everyone knows we have a new Fed chair. And as we think about a Fed run under Kevin Warsh versus Jerome Powell, I guess, what are some of the key differences? How are you interpreting it? Does it matter? Just give us a little background here.
Yeah, so Warsh clearly has come in with more of a dovish bent. I think you can see that in all the talk surrounding his confirmation. At this point, though, I think his hands are largely tied, and this poor man is going to have to walk a tightrope, much as Jerome Powell did, between that. I don't want to call it political side of things, but the reasons, right, to be more dovish, to see more rate cuts. Warsh, actually, it's very interesting. When he was previously a member of the Fed back in the great financial crisis timeframe, he was very hawkish back then. So he certainly has had a change of heart. He blames this, and I think your viewers, Taylor, will love this in particular. He blames it on AI. He said that AI and tech and all of this new innovation has essentially changed the potential run rate for GDP growth so that we don't have to have rates quite so high. We can see them be lower given all these other balancing factors. But he's stuck, I think, in a pretty tough position just with where inflation is. No one on that committee wants to see inflation get out of hand. Will he cut? Won't he cut? At the end of the day, he's just one vote on that committee. So he still is going to have a really hard path ahead, gaining consensus in that group of individuals as far as a rate path will go from this point forward.
And Lauren, and can you give folks some perspective on how the voting at the Fed happens? You mentioned he's just one vote, and I think that's so important because a lot of people think everything will be fundamentally different just because of this one individual, but it's not how it works for the Fed, right?
Not at all. The Fed chair is only one vote on that committee, and these governors, they have very long terms. These are 14-year terms. So they're kind of different groups of individuals who have votes, the kind of core Fed governors, as well as the presidents of each regional bank. Those rotate in and out over a 3-year kind of cycle. So you'll be voting one year, say if you're the president of the Fed Bank of Boston, or next year it'll be this other list of regional Fed presidents. Again, those individuals, they're not nominated by the president, they're nominated by the regional governing body for each of those regional banks. So a lot of, I think of this as not quite checks and balances, but just a lot of different pieces that come together to form that voting committee, the FOMC. And at the end of the day, the Fed chair, he can push signaling forward. Warsh has made a lot of comments about what he thinks communication needs to be out of the Fed and how that needs to change compared to how they used to do it. But at this point, he cannot wave a magic wand and say, no, we're cutting interest rates by this much. There are a few other more dovish voices. Myron is one who, again, was nominated by President Trump as well, and who has come in very, very dovish. You can see it in the dots plot and in some of his dissents. But absent those two, we've really seen most of the rest of the group get more vocal about their concerns on inflation and the need either to hold interest rates steady or potentially even to increase interest rates from this point.
Yeah, and I think that's important when we think of the last inflation report that just came out, the most recent months. I think leading into this year, when the CPI is between 2 and 3%, you can have a lot of those debates, right? Of, well, I know the Fed likes a 2% target, but lately it's been close enough. Let's think about this over a long term. But with the most recent inflation report, that number jumped pretty significantly. And my comment to folks has been, I think even with more dovish folks in the Fed, it's really hard to ignore an inflation number like what we saw from the last month's report. So I guess how are you viewing that as far as the path forward?
Absolutely. And not just the CPI, but the PPI numbers we got last week too, 6% headline. I mean, that's a big number, and that is going to flow through. It's really interesting to me that this is a pretty broad-based inflationary environment. It's not just oil prices, right? It wasn't just tariffs. This is elevated inflation on both the goods and the services side of the equation. We've actually seen it wasn't even just April, but February and March were both a little hotter than is seasonally normal for some of these inflation trends. So I don't think it's a one and done. I don't think we can just ignore all of these trends. And Taylor, that's something we've been saying here at ITR for quite some time, that these are broad factors. These are really pervasive inflationary drivers. It's never just one thing. We've been warning about not just the commodity side of the equation, the wage pressures, and then those just more boring fundamental factors like the money supply, the velocity of money, treasury issuance. I know you show these same charts during your keynotes that I do. There are really, really broad reasons for pricing pressure to be going up, not down. And I think it's wishful thinking to say, oh, how soon can we start cutting again? I really think that's the wrong question to be asking right now.
Yeah. Yeah. And for all of the viewers, we've talked about this profitless prosperity idea for the last year now. And, Lauren's exactly right in giving us more evidence behind that. It's not just commodities, it's electricity prices, it's labor, it's the money supply. There are so many different indicators that we look at ITR that just highlight we need to be worried about persistent inflation, higher than comfortable inflation, however you'd really like to describe it as we move forward. And I know a lot of you look at the Fed dot plot. We get a lot of those comments too. The Fed has an extra layer that they have to be careful of, which is their messaging.
Mm.
And that's where we differ at ITR is we always say, we'll tell you the truth. The Fed will tell you what they want you to hear, right? And when you look at that dot plot, it says interest rates basically staying flat for the next 3 years in the longer run. And I think we would disagree with that, Lauren. I'm curious to get your thoughts, but last I checked, we're a little bit more concerned about higher rates when we move forward here.
I mean, I personally disagree with it. Yes, completely true, Taylor. I think as I look at the dots plot, one thing I'm taking away from that right now is just the increased spread. So those dots getting a little more stretched out, a little more disagreement amongst the committee. So I do think we have to watch for, just how much dissent we get. The Fed, more than anything, they need to maintain their credibility and their independence at the end of the day. But yeah, the signal from that dot plot, it's not great right now. I think that's why we at ITR, we like to take our cues from the bond market instead, because they will tell you what they really think, and you'll see it in those borrowing costs and in those yields. But I agree with you. I've been saying for a few months now, I would not be surprised if the next move in rates is up, not down. And I think the bond market is starting to come around to that viewpoint as well. So I'll put my 2 cents there.
Yeah, and folks, for those of you paying attention, the bond market was clearly joining the conversation about inflation concerns when we saw the bond yields rise this week. And we're all smart as economists, but I don't know if anyone's smarter than the bond market. So that's really a key indicator that we watch closely here at ITR. And so, Lauren, when I sum up all of this information, we've been telling folks for a while now, if you need to borrow money, if you need to invest in your business, you need to think about doing those things sooner than later, because I still worry that there's a reality where consumers and businesses think that we're headed for a lower interest rate sometime in the next year or two. And I think we both would confidently say that's unlikely. And if you want to make some of those moves, make them sooner, not just because of timing interest rates, but because of how we think about the second half of the decade with sort of 2030 looming around the corner. I guess any other primary takeaways you'd have for businesses as they're thinking about what this means?
I think that's a great one. 2030 is creeping right up on us very quickly. We're getting to the point of if you want to borrow to do anything before 2030. That is the first question that I would have. But no, we've been saying for, gosh, I don't even know. It's more than a year now that,
Yeah.
maybe we will see minor cuts, and we've had a couple little, moves down in rates, but what is that benefit doing? Is that borrowing cost, that 25 basis points really make or break for that investment you're going to make if you're losing 6 months, a year? I mean, coming into 2030, you need not just to make the investment for that implementation to happen, to actually get some reward from it before we hit the peak and start slipping down. I think that is exactly the time frame, Taylor, that folks should be thinking about.
Absolutely. We'll talk about what this means for the housing market on another podcast, folks. I know that that part weighs on your mind here personally as well. But for now, we Sure hope you found this information helpful. Connect with Lauren and I on LinkedIn. We're pretty active there. Always love to hear your thoughts and feedback. Head over to our website, our LinkedIn, to hear more from Lauren on FedWatch every week. This is the world she lives in, whether she likes it or not. We appreciate her very much and the insight she provides us with. So, Lauren, thanks for being here. We appreciate that.
Thanks for having me on, Taylor.
And everyone, please, as always, like and subscribe to Trends Talk wherever you listen to your podcast. We look forward to seeing you next week. Thanks so much. Take care for now.